We get so focused on the top line numbers, and the top line numbers have gotten so out of bounds in terms of being driven by a handful of names that if you're truly rooting for a healthier economy and participation from all, a small cap rebound, an international rebound would be good for kind of the not just the US economy, but the global economy.
Welcome back to the ETF Zoo. My name is Dave Nadig here at ETF.com. I'm joined by a regular cast of characters. We've got Sumit Roy from ETF.com, Kirsten Chang from Vetify, Mike Akins from ETF Action, and of course, Nate Geraci from ETF Prime and Novadius Asset Managers, Novadius Advisors. What is it, Nate? Give us the update. What do you actually
wealth
call
management?
Well, Novadius
If you
Wealth
just want to say
Management.
Novadius, that works perfectly fine.
Novidia sounds great. Well, look, we've had a lot going on in the last couple of weeks. It's certainly been not a slow start to the year. A lot of us are talking about what's going on in international markets. I'm going to go ahead and put up a slide, but Kirsten and Nate, you both have been on this hobby horse a little bit about the outperformance gap that we've seen in some in some international markets. Do we think this is something that's going to last, or do we think this is sort of a short-term thing?
First off, it's refreshing to hear Nate advocate for international markets this year, because there were plenty of times I would do his pod and I could feel him rolling his eyes at me over the phone. So it's validating to see that he finally thinks this could be the year. I tend to believe that everyone should have some allocation to international, whether you like it or not. Purely vacation from a very concentrated tech bet in the US right now. The S&P, you look at that, up 18% last year. Over half of those gains came from the top tech names. So if you strip that away, you're not left with nearly as much. There's a lot to like in international. If you're feeling the market's kind of top heavy, which it is, Europe potentially a great way to diversify away from that large cap tech trade, because tech is really just a fraction of those European markets if you look at the sector breakdown. Add to that the weakening dollar. You've got that crucial currency hedge. And by the way, emerging markets, I just wrote about this, they were on fire last year. They've been stealing the show again this year. IEMG from BlackRock topping the flow charts again. AVEM, Avantis doing well. Not to mention the value prop, right? They're trading at something like 15 times forward earnings, even after the big run up last year, versus the S&P, which is something like 22 times earnings. So a lot to like in that story.
Nate, what do you think?
So let me add a little bit of context here to what Kirsten was saying. So I think everybody here knows I do these 5 ETF predictions every year. And one of my predictions this year is that international equity ETFs will absolutely obliterate their annual inflow record, which I'll give some data around that. But Kirsten is right in that it's funny. I've completely flipped my stance on this, even from when the last time I was on here in this zoo, when you might remember, I was saying that investors and advisors needed to see a much longer period of outperformance from international stocks. But I think with how handily international stocks outperformed last year, that's been enough to attract real attention and I think real conviction. And if you look at flows last year, we started seeing this. Well, actually, international equity ETFs had a record year. They pulled in something like
Yes, they
$250 billion. And I got that number from State Street, by the way, but that easily beat 2021's record of nearly 200 billion. So again, I think we shatter last year's record. And if you look at flow so far this year, things are off to a decent start. So I see IEMG and EEM both in the top 10 of all ETF inflows this year. So I think a good early sign. I think Kirsten hit on some of the main drivers. I think number one, I think we're going to see performance chasing from investors and probably more so from advisors, because we all know a lot of advisors have been heavily overweight US stocks. And they're going to start to wonder, is that the best approach moving forward? And you know why
Well,
they're going to
that
start to
that
wonder that?
implies for it to be the wrong approach, the market has to be down, right? So like when we started talking about this back in April, when we've had the first Sell America trade, everybody got on my case and said, absolutely not, never going to happen. Eric Balchunas like slammed the table and was like, nobody's going to put money in international. It's underperformed for 10 years. 1 year of outperformance is going to make a difference. Isn't there a significant risk that he's right and everybody piles in precisely as what we've seen for the last 9 months inverts?
That is always a potential chance that that happens. And quite frankly, if you're betting money, the odds are probably better to go that route. But I think with how much international equities outperformed US last year, if you're an advisor managing client money and you were heavily under allocated to international, at some point, clients start asking questions around that. And
But
so,
but we s but flows at the end of the year said the opposite. It flows like the flows going right into the end of the year was just gas pedal on US equities, which to me looked like everybody window dressing to get back into the US trade.
well, but I think again, you have to look, Dave, we have historically elevated valuations in the US, right? I think that there are a lot of signs pointing to a weaker dollar. And everybody here knows I'm not big into market calls at all. But I think when you have the Trump administration basically stating that a weaker dollar is the goal, you have to pay attention to that because obviously a weaker dollar typically bodes well for international stocks. So I think it's not just the performance chasing aspect. I think that you have to look at the bigger picture here. Are people and advisors going to just stop allocating to US? No. And again, if you look at the flow leaderboard I mentioned earlier, guess what the top two ETFs are there? It's VU and SPYM. So to your point, I don't think that's going to change overnight. What I'm saying is that I do feel like there's been a real sentiment shift here and international is being taken much more serious than maybe it has in the past.
I
I'm
have a
glad you
question.
brought up the dollar, Nate, because obviously that was a big reason international outperformed last year. 9% loss in the dollar versus rival currencies that boosted returns. But obviously it wasn't just that. Maybe we could talk a little bit about what caused the huge outperformance in international stocks. Personally, I think you guys can tell me if you disagree. A lot of it are the policies coming out of the current administration. The tariffs last April were a big trigger, and policy, not only the tariffs, that what's going on with NATO and Europe having to increase defense spending, that's a trigger as well for money flowing into European equities and things like that. So, my big question is this something that's going to last 5, 10 years going forward, or is it just a 1, 2, 3 year phenomenon because of the current administration and the policies coming out of there? What do you guys think?
Yeah, I think it's a decent question. I mean, apart from that sort of long-term mean reversion of these underperforming markets coming back, you do have a lot of growth drivers in Asia, and those are long-term as well. You have exposure all along the AI value chain, especially in China, South Korea. India obviously fell behind last year in terms of performance, but there's a lot of optimism around earnings coming back, foreign investment flows stabilizing there. So you do have some fundamental drivers that I think have some legs.
Let's shift then, because the other side of that is the bond trade. Honestly, if we're going to be talking about the dollar, and again, I think almost all of us have probably written something about this in the last little while here. But the the bond trade has been wild. I mean, this is Todd's not here, but we'll steal his chart from him. Like, this is a great example of what we're seeing here. We've had this spike in money market assets. We've got yields are starting to come back up again. Like, is this the year that we see a huge move back into fixed income?
Well, I've said for some time that we've had a golden age for at least for active fixed income for the past few years. We did see fixed income flows kind of slow a little bit last month, so some people might anticipate a sleepier year ahead. But I actually think we're going to continue to see an explosion in that active fixed income ETF arena. 400 billion in inflows last year. I think we could easily top that this year for fixed income. Short rates coming down, anchored by expectations of sort of like the easing Fed. So we're probably going to see investors extend duration, buy some credit. And, to your point, money market funds are losing their luster a little. So if any of that trickles into the credit duration risk spectrum, you're going to see a huge inflow there. And so I think bonds are continuing to be a big story.
Yeah, Dave, I'm glad you put up this chart because I'm calling this the year of fixed income ETFs. And I think when you look at the amount of money that is currently sitting in money market funds, think about why it's there. It's typically because some investors are either very conservative to begin with, or they're conservative at the moment, right? And that they're currently taking more of a risk off attitude towards the financial markets. But as that chart shows, if you look at yields coming down and money market funds paying less than 4%, and then you add in expectations that shorter term interest rates could fall further later this year. We'll see, but I think that's the baseline expectation. I think some investors and advisors are going to try to get out ahead of that and allocate towards higher yielding areas and potentially try to lock in higher yields. And because of the overall conservative nature of the money that's in money market funds, this money's not going to flow into crypto and higher beta stocks and those sorts of things. It's going to find a home in fixed income, in my opinion, and that bodes well for fixed income ETF. So I think for me, fixed income's kind of a boring topic, but I actually think this is a really interesting one because if those shorter term yields continue to come down, I'm fascinated to see if money actually comes out of money market funds and then where it goes. Again, I think it goes into fixed income ETFs,
Yeah.
or at least a big chunk.
I think I don't disagree with either of your calls, international having a record and fixed income having a record this year. But I think we need to start putting some guardrails around flows and records because every year, every category has a record in ETFs, right? So when you say international or fixed income, I think you have to look at it relative. And so, in perspective, bonds over the last 10 years have gotten 34% of flows into ETFs. 65, 66% has gone to equities. There's some outliers there for other stuff, but if you just focus on those two categories. So are you saying that we're going to set a record in terms of that ratio? Or are you saying we're going to set a record in terms of, just overall flows?
Because
Because
we
that's
know the
not
number's
really
going to
too
be
hard
big.
to say.
Yeah, the number's going to be huge. We know that.
Mike, you're completely taking the punch bowl away from the ETF Zoo party here. We're trying to have a good time, make some
Well, I think it
prognostications.
does make a difference though, because like right now, the entire ETF space, if you just focus on equity and fixed income, is 83% equity, 17% fixed income. So flows over the last 10 years have actually been outsized to fixed income in that mindset, but obviously equities have vastly outperformed. So it's a lot of it's just that rebalancing effect. So the question is to move the needle, whether we're talking international versus US or fixed income versus equities, is that ratio. And I think that's kind of one of the things that we need to watch in terms of being a buffer for returns.
Well, and there's bonds too. I mean, let's just jump into our next topic, which is the return of the Sell America trade, which we got off of for all of 3 or 4 weeks, and here we are back to talking about people selling their treasuries again. But it does have an impact. I mean, this is a chart Sumit used. Like we did see 10 years spike very recently. We have a lot. We have $100 billion pension fund saying that it's divesting entirely from treasuries. Now, look, a lot of people are going to make noise about that, and we all know that these are tiny, tiny little amounts of flow. But if enough of this starts happening, if there's enough anti-US bond sentiment, what we would expect is exactly what's on this chart. Is you would expect people to sell them, and that would spike the longer-term yields. And most folks that are allocating to treasuries internationally aren't buying T-bills so much as they're buying the 10 or the 20 for long-term treasury allocation in their own space. So is there some risk that we actually steepen this curve way out? We cut rates on the short end, and all of a sudden the 10's back up towards 5% because nobody else wants to own it, and that flushes all the money out of the money markets? I don't know. That's a story I could tell.
I'm much more concerned about rates jumping on the much longer end of the curve. If we start getting out, 20 plus years, I definitely have some concern around that. I'm still not in the camp of taking on a lot of duration risk. As it pertains to the Sell America trade, just in general, I'm also reluctant to make a proclamation around that as well. I think it's getting a lot of headlines. I feel like there's been a lot of political emotion injected into the markets over the past year or two. And so you're seeing a lot of these types of things pop up, I think, because of that. So I'm not as negative here as maybe some other people.
Sumit, this was a piece you'd written. Do you have any thoughts here? I mean, do you think this had some real legs?
I mean, Sell America, so far, it's only been a one-day phenomenon. This iteration of it was in response to what happened with Greenland over the weekend. We did see the S&P 500 sell off 2%, but next day it rebounded. In the bond market, it might have more legs though, but it's hard to disentangle. There's so many things driving the bond market today. It's the debt concerns, deficit concerns, inflation concerns.
Fed independence.
Yeah, all of these things. I mean, look at what's going on in Japan. The 40-year JGB hit an all-time high, 4.2%. And the BOJ's benchmark rate is 0.75%. That's a super steep yield curve in Japan. We don't have anything like that in the US, but it just goes to show that it is not just a US phenomenon. We're seeing long bonds all around the world at very high interest rates, and they're not coming down regardless of what central banks are doing. The Fed cut 3 times last year, yet the 30-year Treasury bond yield went up. So we're definitely in a new environment when it comes to bonds. And this is something investors are going to have to grapple with. It's a very
Yeah.
uncertain time.
I read your piece and I thought it was really good, Sumit. I don't like the title. I think it would be better titled "Sell Mega Cap Tech" because, in essence, that what you're saying, right? I mean, we've seen this massive growth of concentration in the U.S. and you have 7, 10 companies taking all the breath out of the room. So you're basically saying, and higher interest rates is not good for large in any sort of growth oriented sector of the market, just in historically, right? Longer duration trade when you think of those higher growth companies. So that's one side of the equation there. The other would be in terms of the yields. I'd be careful saying that historically high. Perhaps we're back to historical norms. We forget that we went through a period, and I'm saying my age here a little bit, but we went through a period of just historically low rates across the world. And some could argue that, coming back to some normalized base is a healthy thing for the economy. There's going to be hiccups with that, and there's going to be some concerns on pricing, but I think we need to be a little bit careful and widen out our view on terms of that, where the rates are historically, and define what you mean by historic.
Well, let's shift then a little bit and talk about the sort of risk on, risk off nature of it, because that's the other thing we talk about with bonds. And look, I mean, precious metals have just been insane, right? I mean, this is silver, gold, SPY, and Bitcoin. And look, this is not a pretty chart if you've been in anything but silver. Let's be just clear about that. This to me seems like something that's imminently shortable. I can't imagine taking a precious metal up 200% and having that be the new bottom. But hey, I'm not going to make that market call. But we have talked a lot about people making safety trades. We have seen massive flows into the whole precious metals complex. I think the other real question here is, how sustainable is that? I mean, how often does gold run up 75% and rebase there for the next 10 years? Or is this, again, just a people parking cash in a place that's not U.S. treasuries anymore? Anybody have any big thoughts on gold, and I guess in particular silver? Holy
I
cow.
think you have to separate gold and silver a little bit. I think there's an argument to be made, and like the Gold Council, the World Gold Council, put out a lot of good stuff. The issuers behind the GLD product, in terms of central bank, and the true belief that there is a policy concern there, and I think that's a true macro tailwind for the space, and can be arguably said if you see the growth of gold on the balance sheets of these central banks, it's real. Silver, I think, has got caught up a little bit, almost like, is SLV held in ME yet? Is it in the meme ETF? Because that's just wild to me. And I think that's not sustainable. But they're both elevated in historical terms. It's pretty crazy. Like, the chart of the year, in my opinion, last year is when GLD, since its inception, overtook SPY and cumulative returns. That was just a crazy concept, and honestly not a healthy concept for the markets, if that's one way to look at it. It's not a productive asset.
Well, but you can say the same thing about Bitcoin, and we've been talking about Bitcoin being the
Please do.
new digital gold for a long time, and that doesn't seem to have worked. I mean, you can sort of look at where the flows have been in Bitcoin, and I think it's reasonable to say that the ETF industry is largely held pat, and whoever's selling Bitcoin down isn't doing it in the ETF market. So, like, is it viable to be thinking about Bitcoin as the new safety play like gold, when we've had this 80% difference in return between gold and Bitcoin?
Never
Something
was.
happened to Bitcoin in October, because up until last October, it was acting pretty well. It was up pretty significantly on the year. Then it just fell out of bed, and it's just been languishing at the bottom since then. I don't know what happened. The crypto people were talking about a big liquidation happen. We'll see if that turns around, but clearly it is not acting like digital gold right now. Gold is gold. We're seeing the flows go into gold. We did see the flows go into Bitcoin ETFs as well, but gold ETFs had almost $90 billion of inflows last year globally. Assets under management, almost $600 billion. So it's not just a US phenomenon. We saw inflows into Chinese gold ETFs, European gold ETFs. Everyone is just piling into gold because they consider it the safe haven that's neutral, that isn't associated with one country. And they're trying to get away from treasuries, which I guess have kind of lost their appeal a little bit after everything that went on last year. Silver, like we talked about, is a little bit different, but I heard some people pointing to the fundamental growth story that's underpinning silver, and that is associated with the growth of solar. Obviously, silver is used in solar panels. It's also used in EV batteries and things like that. So there is a growth story there, but the doubling in the price of the last 2 months, I don't think has to do with that growth story. That's more of a flow story. $10 billion went into silver ETFs last year, and that's significant for a market the size of silver.
Yeah, there's a liquidity element there. You're kind of talking apples and oranges when you're comparing, liquidity of gold versus liquidity of silver.
Nate, what are your thoughts on the current state of Bitcoin? You follow this probably closer than anybody else on this podcast. Probably you wrote your whole podcast about crypto.
I still feel the same way. I'm a broken record here in that I'll be the first to say the jury's still out on whether or not Bitcoin is digital gold. It's still early. And I actually like the way our friend Bloomberg's Eric Balchunas refers to Bitcoin, which is as it's gold as a teenager, right? It's still volatile. It's a little immature. It's not quite sure what to do day in and day out.
Temperamental.
I think
Got
that's a good
zit.
way to think about it. But here's what I would ask all of you. And let's think about the overall backdrop here. So I think again, the consensus is shorter term interest rates will potentially come down or continue to come down this year, right? You look at the inflation data, we still have, I would say, relatively or at least somewhat sticky inflation. There are clearly concerns around the US's fiscal health. We talked about a weaker dollar earlier. There are clearly concerns over US equity valuations. We have ongoing geopolitical tensions. So start adding all of those up. To me, that seems like a pretty good backdrop, certainly for gold. And then if you want to say Bitcoin does have some characteristics of a safe haven asset, then I think you would have to say for Bitcoin as well. And even if you don't believe that, let's just take Bitcoin itself. If we have rates coming down, maybe there are concerns over US equity valuations and people want to look for another place to go. Maybe Bitcoin siphons some of that. Now, if we start getting into other crypto assets, I've said many times, I think once you move beyond Bitcoin, most of the other crypto assets out there you have to view as risk on. They're like high
The tech
tech.
stock. Yeah.
Yeah, they're tech stocks. So I think that's different, but I do think Bitcoin has shown enough in its early life. Remember, it's only been, what, 16, 17 years now, which is early in a financial asset. Gold's been around for 5,000 plus years. I think it has shown enough to at least indicate that longer term it could become digital gold.
Ready to get his driver's license. Got it. All right. Well, let's shift to another "Are we too early?" question that we seem to ask all the time, which is small cap stocks. Mike, you've been writing about this a little bit. Are we actually seeing a rotation here? I mean, we've had some flows, but this feels very tentative to me. What do you think?
So I think actually you can draw some parallels to small caps, internationals, and the dollar, right? So I think we just all have to recognize that if we're rooting for a small cap rebound to a certain degree or an international rebound, a big catalyst to that has to be a weaker dollar. Like we went through a 15-year bull run in the dollar where all we saw was concentration in the US stock markets get more and more to large cap mega tech names and smaller for US stock names. So if you put it in a flows perspective, I mean, if you look at a breakdown of the ETF market, and I always to preface this, I love to look at asset allocations and total in the ETF market as a sentiment for how people are positioned relative to the indexes themselves. So the easiest way to think about it, ACWI is 61% US stocks. ETF assets is 83% US stocks, right? There's a clear sentiment there. And then obviously look at it. You can do the same thing for small cap, right? And if you look at ITOT, which is the S&P total US market, 74% is small cap, or 74% is large cap, the remainder being mid and small cap companies. If you look at the breakdown of the ETF market, we're currently in 86% large cap ETFs versus 14%. So the flows story, is one thing, and we can see that 85% of flows over the last 10 years has gone to large cap names. So if we think about it from a relative perspective, let's put it there. But is it going to be real? I think a big part of it is the dollar weakness going to stick around? And that could arguably be a longer term catalyst. We don't need to keep dropping, but if it just stays soft, I think it can be a big catalyst for Now, not just small caps, but for internationals, for industrials, for materials. We get so focused on the top line numbers, and the top line numbers have gotten so out of bounds in terms of being driven by a handful of names that if you're truly rooting for a healthier economy and participation from all, a small cap rebound, an international rebound would be good for kind of the not just the US economy, but the global economy. With all that being said, I think the policy backdrop suggests industrial reshoring, a weaker dollar. A lot of things suggest that this might be a true inflection point because it has some backbones. But recognize it has to come from somewhere. So the top line number might be worse, but the bottom line number could be better. And I think it's a hard pill for people to swallow when they look at their allocations and realize what they truly own. But that is kind of what you're talking about when you're talking about small cap rotation or international rotation, is getting away from this magnificent eight it looks like you have up here. But the S&P 500 being the other, I got it. But yeah, so just I'd throw that out to the whole panel though, because that's my view of it when I think about small cap rotation. As an investor, I believe being diversified makes a ton of sense and it goes through cycles, and I think you should always be allocated down market. But as a catalyst, I think the whole story of today's topic actually might be that catalyst.
I tend to agree. And I think that, small caps also there's a lot of room for growth in the active space in particular. There's a very untapped market there in terms of ETFs. But I think we're seeing more and more dispersion among the Mag 7, Mag 8s, whatever you want to call it. And a lot of it kind of comes down to where they're putting their money in AI. Certain companies just don't have as clear a path for CapEx spending to ROI. So given all the massive spending, I think the market's finally starting to differentiate among who has a clearer path and those who are just kind of spending to catch up. I was looking at a chart from Goldman in the middle of last year. The average correlation of the stock returns of some of these hyperscalers was 80%. Now it's fallen to something like 20%. So we are seeing a lot more
Well, but that's good, right? We want companies to perform differently, right? That actually means that the market might be healthy. I mean, I'm rooting for a small cap rally. It would be nice to actually see some of this happen. But I do think it gets to be a tough sell to go to an advisor and say, golly, you're only in 10% small caps. You should really be more like 20. I think that's a really tough sell.
There's only so many times you can pull up the small cap value and QQQ chart from the tech bubble.
Yeah, exactly. It's well, I think that that's true in a lot of places where there are things that we believe should have their day, but small cap value seems like forever waiting.
Yeah. I mean, I truly think it's a policy concept, right? I mean, we have been, our markets have been disconnected from the economy for a while. And this is not political at all, because I stay the most apolitical as I possibly can in terms of my business and the markets. But I do think that there has to be a catalyst that will force the hand of the market to go downstream or to go international. And whether that plays out good or bad, it could be a good thing for participation in the markets in these areas that have been left behind.
Yeah, I agree with that. And that's kind of what I was saying earlier with international. I think we have started to see that catalyst because the performance has been significant enough to catch investors' attention. I don't know that we have seen that yet on the small cap side. And so I'm not as optimistic there at the moment. I agree with you that most investors and advisors, you should probably have some allocation to small caps, but are you going to overweight there? I don't know that that's the right move. I will say this. I was visiting with State Street's Matt Bartolini yesterday, who I think we all know here. Matt is someone I really respect in terms of how he thinks about the markets. And he was very constructive on small caps overall. And he basically pointed to some of the things you were talking about, Mike. I mean, shorter or lower interest rates moving forward, which we continue to talk about. That obviously means lower borrowing costs for smaller cap companies, which have a lot of debt. And I think this kind of plays into the whole weaker dollar concept. He mentioned obviously much more attractive valuations for small caps versus large caps, which again, we continue to talk about here today. And then there were some other factors when you talk about policy. He talked about the One Big Beautiful Bill Act and potentially less trade uncertainty moving forward, which I don't know, again, that I'm there on that yet with Greenland and everything else. But his point
But it would be
was,
nice.
yeah, if you look at all of this together, there are a number of reasons to be positive on small caps. So I can see the case there. I think I'm still more in the wait and see category though, overall.
I think if you look at the revenue breakdown of like the Russell 2000 versus the Russell 1000 or the S&P 500 versus the S&P 600, what you'll see is that, 80% of small companies make their money here in the States. It's only 60% or whatever for the large cap names. And how to think about relating that back to the economy is to the extent that the dollar is cheaper, it's more competitive for those small industrial based companies to sell to their potential buyers here in the States than those buyers going overseas and buying it. It is a potential tailwind. And I say potential because it's a wild world we live in and everything can change next week when we have this call again. But
Yeah, and real quick, I just ran performance. I mean, if you look at IWM year to date, just the Russell 2000, it's up what 9% versus the S&P 500, which is essentially flat. It's up like a half of a percent. So if you continue to see that type of outperformance, then I think we will start getting a lot more looks in the space.
Yeah, I do think it's going to come. I mean, put up the earnings chart for a reason. I do think it does come back down to earnings. And a lot of what we've seen has been concern about whether all of the earnings in the economy are just going into the tech AI play or whether they're actually going to come back out into the real economy and show up in these numbers here, which, as always, time will tell and remains to be seen. Nate, I couldn't let you go without getting you to at least comment on one more crypto chart. This is the last 6 months and 4 big crypto assets, all of which now have ETFs trading against them: XRP, Solana, ETH, etc. I'm not doing this to say her number went down. We have 140 products queued up to launch in the next quarter, probably, all targeting various components of not just these 4 securities, but everything from Doge on up. So at what point does the retail market start seeing numbers like this and get really gun shy about wading into XRP as the next big thing, or Polkadot, or Pengu, or whatever the next one's going to be?
All right, so I have two easy responses to this. First, I think when you look at the performance of any of these crypto assets, you have to look on a much longer time scale. So I keep seeing people talk about, for instance, IBIT's recent performance, which yes, it's down, but I'm running the chart here. If you run IBIT back to when it launched in January 2024, guess what? It's up like 92%, which is what, more than double the S&P 500. It's not even close. So I think you have to keep that in mind, and that's the case with, I'm not going to say a lot of crypto assets, but certainly a number of crypto assets. I think more importantly, Dave, what this points to is something I keep talking about, which is I think because of the divergence in performance among crypto assets and the volatility, you're going to see investors and advisors look to crypto index ETFs. I'm highly bullish on crypto index ETFs. I think that a lot of investors and advisors are just going to throw up their hands and go, I don't want to be in the business of picking XRP or Solana or Pengu, whatever it may be. And they're going to allocate to an index-based approach. So very simply, that's how I view those. Those are my two key points on this.
I won't make a call on the performance of crypto, and I'm not smart enough to. I don't know the metrics, and most people that follow me know my view broadly on the space. However, what I will say is I think we are setting up for a clear story between institutional adoption and retail. And for crypto to be long-term successful, there has to be institutional adoption. And I think fourth quarter hit a pause on that. If we look at fourth quarter ETF flows, it was positive for the entire digital asset space. It was $1.2 billion positive, which is really small. But if you look at that 1.2 billion, 2.5 billion positive for altcoins and negative 1 point whatever it was, 5 billion for Bitcoin and Ethereum. So the 13F data has not come out yet, but I have pretty good suspicion that we will see institutional ownership in the fourth quarter have gone down. And there has to be a replacement story from the original OG whales of Bitcoin who are clearly starting to realize some of their wins or lose faith in the story to an adoption of institutional. That has to play out for this story to be long-term positive, in my opinion, because if it continues to be a retail-driven story, there's not enough retail to make it work.
My
Well,
only
and
rebuttal to that, Mike, is just that institutional adoption isn't just about institutional investors buying, say, spot ETFs. Think about some of the headlines we've had recently. Earlier this week, NYSE came out and announced that they're building a trading platform for tokenized equities and ETFs. We've seen Nasdaq come in with similar initiatives. I just saw today that FM Investments is going to launch tokenized shares of their ETF. So we can talk about permission versus permissionless blockchains and all
Well,
that. We're not going to get into that type of
let's
detail.
separate tokenization from crypto, though.
Yeah.
But it's
That
not.
is
But
very different.
But it's not. It depends. Where are these tokens riding? Are they riding on
No,
Ethereum? Or they're
I
riding on
agree. And
Solana?
if you are right and this all takes off and everybody starts trading ERC20 tokens instead of SPY, then yes, the price of ETH will moon. Like, yes, there is a connection between the adoption of these ecosystems. However, I still remain enormously skeptical of crypto or of tokenized equities on US rails becoming a giant big deal. We're solving a problem that actually does not exist for the vast majority of money that's in the equity market. Doesn't mean it doesn't happen. It doesn't mean there isn't some interest in it. But I think tokenization of US equities is going to go through its direct indexing moment in the next 5 years, where lots of stuff will be available and there'll be a few $1 billion chasing it around, and that'll be it. I mean, remember, we've had blockchain money market funds now for years, $600 million. Like, it's not a big move, right?
And along the way, there'll be horror stories about how the retail person who tried to play in this game got absolutely
Fat finger
destroyed
to
on
trade.
execution prices.
Yeah.
Or execution liquidity is not there in after hours. Unless the market somehow starts trading 24/7 the way it trades between market hours here in the US, tokenization doesn't have the liquidity to back it up, and it's not going to be a net positive for the investor experience.
Yeah. Well,
Just on
look,
Bitcoin. Sorry.
but
I would add it's still early days. We talk about IBIT. That fund just turned 2 years old last week. But I just want to throw out a quick stat. Nate, you're going to love this. Vetify just did a webinar with Bitwise, and we pulled some 250 advisors, found that 56% of them personally own Bitcoin in their portfolios, and about a third of them are currently allocating for their clients. So it is definitely permeating the investing psyche more and more, whether we like it or not.
Well, yeah, and
yeah,
think
no,
about we've had some gates come down here too recently, right? I mean, we saw Vanguard open up brokerage access to spot crypto trading. Morgan Stanley, you go on down the list of these huge firms that were gating access and now allowing everybody to access these products. I think that's a big story. The other point I'll make though too to both Dave and Mike is just that guess what? Technology improves, society improves. Or else we'd all be sitting around, riding, what is it, a horse and buggy and all of that, right? So I'm not comfortable sitting here today and saying the ETF wrapper, as much as I love it, and we all love ETFs, is the end all be all, and it's never going to get any
not,
better.
But there's a big difference between this changing in the next 2 years and the next 10. And a lot of people are betting on it changing in the next 2. Like, this
That's a different conversation, though, than saying that,
right?
this stuff's going to zero, it has no value, those sorts of things,
I'm not
right?
saying it's going to zero, but all those gates came down that you're talking about. We had the best regulatory year, the last 6 months, the best regulatory 6 months in the history of Bitcoin. It's down 20%. I'm just saying.
But again,
all
but
these
it was
positive catalysts.
maybe it ran
and it's
up.
down
Maybe it ran up
20%.
before then. IBIT's up
And-
at 90% plus.
Right.
since
So
it
then
first
what is
launched.
the catalyst for it to go up? If all these hurdles come down and it goes down, I'm just saying, I think it's going to get interesting to see who actually makes big long-term allocations to crypto as an asset class while all of this other stuff is going on, right? Because imagine a world where NYSE launches crypto trading and for a year nobody cares. Like just no volumes to speak of. It sits here at 5 or 10% of big board volume, and they declare that a giant success. Do you really think that drives ETH up 100%?
Dave, are you watching the behavior of retail investors? They want 24/7 access. They want real-time settlement. It's always about, faster, cheaper.
Instant
The market's
gratification,
going to
yeah.
continue to move that way. So whether we like it or not.
I couldn't agree more on the technology front. But let me ask you this. Would you have rather gotten for return on your investment what the price of the iPhone has done in 20 years or what the price of Apple stock has done in 20 years? We need to separate the technology, tokenization or whatever you want to call it, from that being an investment, right? Sure, companies that build flat screen TVs have done awesome over the last 20 years. Guess what hasn't? The price of flat screen TVs has gone to zero. And I think that is a way to think about it. I'm not saying the crypto won't go up, but we need to separate investment of the technology, like of the asset,
From
what
the
we're trying to
technical.
do, versus the technology, which is good for everything. If technology drives down the prices of settlements and everything else, I'm all for it. And if there's a better way to tokenize instead of an ETF, I'm all for it.
Yeah.
But that is different than an investment.
Are you exhibiting that same behavior when you're analyzing stocks? So if you're looking at AI related stocks, are you separating the technology from the
Yes.
company?
Yes, you
Okay,
should.
I just want to make sure. I want to make sure we're being consistent
Absolutely.
here.
Yeah. I
Right?
mean,
I mean, look at just the iPhone's the perfect example, right? Like how cheap you can get your iPhone. Like the iPhone price has not really gone up relative, like to the price of Apple or flat screens
yeah.
TVs.
The price of AI,
Technology becomes a commodity.
and
What
the
have
price of
commodity
AI
prices
is
do?
coming down. Like the price of AI as a tool is crashing towards zero
Oh,
very quickly.
unbelievably quickly.
Very quickly. So yes,
Yeah.
I do think that applies exactly to the AI boom. All right. Well, this has been
This
a
is fun.
fun and vigorous conversation. Thank all four of you for joining us. We'll see everybody back in 2 weeks when who the heck knows what this industry will have come up with. Cheers, everyone.